Financial capital represents the pool of funds available to an organization for use in producing goods or services and generating future cash flows. It includes equity, debt, and internally generated cash. In traditional accounting, this capital is measured and reported through the Statement of Financial Position and Statement of Cash Flows. However, under the International IR framework, financial capital extends beyond accounting numbers to include the organization's ability to access and sustain funding over time. This broader interpretation links financial health with investor confidence, creditworthiness, and capital market reputation, integrating short-term liquidity management with long-term value creation. Measurement of financial capital is relatively standardized due to established financial reporting frameworks such as IFRS. Assets and liabilities are measured at historical cost, fair value, or amortized cost, depending on classification. Nevertheless, measurement challenges arise when assessing intangible financial capacity, such as access to future financing or the stability of investor relationships. These are not directly quantifiable but materially affect the organization's financial sustainability. Additionally, volatility in fair value accounting under IFRS 9 introduces subjectivity that may distort performance perception, especially in uncertain markets. Hence, disclosures must emphasize not only numbers but also qualitative explanations of financial strategy and capital management. Disclosure issues center on ensuring transparency about sources of capital, funding structures, and risk exposure. Organizations must explain how financial capital is raised, managed, and allocated across strategic priorities. The International IR framework encourages linking financial capital disclosures with other capitals. For instance, showing how investment in human or intellectual capital drives long-term returns. This integrated disclosure helps stakeholders understand trade-offs, such as short-term profit maximization versus reinvestment for sustainability. For regulators and investors, such context is crucial in assessing resilience and stewardship of financial resources. A persistent disclosure challenge is balancing materiality and conciseness. While IFRS requires detailed financial statements, IR emphasizes communicating the essence of financial health in a way that remains accessible to a wide stakeholder audience. Too much detail can obscure insight, while too little may omit critical risks. Effective integrated reports combine concise numerical data with narrative explanations of capital structure, liquidity, gearing, and dividend policies. This dual focus aligns quantitative rigor with strategic transparency. Integrated reporting also demands disclosing interdependencies between financial capital and other forms of capital. For example, investment in sustainable manufacturing, manufactured capital, or employee well-being, human capital, may temporarily reduce financial capital but enhance long-term value. Organizations must explain such trade-offs clearly to prevent misinterpretation of short-term financial declines. Integrated thinking therefore reshapes financial disclosures from static reporting to dynamic storytelling about how financial resources are used to generate broader societal and environmental outcomes. Ultimately, measurement and disclosure of financial capital require combining IFRS-based precision with IR-based narrative insight. Finance professionals must ensure that disclosures reflect both financial performance and strategic intent. Transparent communication of funding sources, liquidity, and capital allocation promotes trust among investors and aligns with the broader goal of sustainable value creation. By integrating quantitative reporting with qualitative analysis, organizations can demonstrate stewardship, financial integrity, and accountability, key principles underpinning both integrated reporting and long-term corporate success.